Finance is an essential aspect of any business as it involves managing the funds and resources of company to achieve its objective. Financial management involves making decisions about how to acquire, allocate and use resources to maximize profit and minimize risk. This includes managing cash flow, budgeting, forecasting and financial reporting. The primary goal of financial management is to maximize shareholder value, which is achieved by making sound financial decisions that increase profitability, efficiency, productivity. This involves analyzing data to identify trends and patterns, assessing risk and developing strategy to mitigate them. To understand finance in business, it is essential to have a basic understanding of financial statement, which provide a snapshot of company financial position. The three primary financial statements are the balance sheet, income statement and cash flow statement. Balance sheet provides a snapshot of company's assets, liabilities and equity of at a specific moment in time. Assets are the resources owned by companies such as cash, inventory and property, while liabilities are the debts owned by companies such as loan and accounts payable. Equity represents the net worth of the company, which is calculated by subtracting liabilities from assets. The income statement provides a summary of a company's revenue, expenses, and net income over a specific period. Revenue are the money earned by the company, such as sale revenue, while expenses are the cost incurred by the company, such as rent, salaries, and supplies. Net income is the difference between revenue and expenses and represent the company profitability. The cash flow statement provides information about a company cash inflow and outflow over a specific period. Cash inflow represents the money coming into the company, such as sale receipts, while cash outflow represents the money going out of the company, such as payment to suppliers and employees. The cash flow statement provides information about a company's ability to generate cash and its ability to meet financial obligations. In addition to these financial statements, financial management also involves budgeting and forecasting, which involves setting financial goals and developing strategies to achieve them. This includes developing a budget, which is a plan for how a company will allocate its resources over a specific period, and forecasting, which involves predicting future financial trends and patterns. Financial management also involves managing risk, which includes identifying potential risk and developing strategy to mitigate them. This include managing credit risk, which involves assessing the credit worthiness of customers and suppliers, and managing market risk, which involves monitoring financial markets and developing strategy to minimize the impact of market fluctuation. Financial statement are the primary source of information that help to assess the financial health of business. The three most important financial statements are the balance sheet, income statement, cash flow statement. The balance sheet provides information about assets, liability, and equity of the company at the particular point in time. The income statement shows the revenue, expenses, and profit of the company over a specific period. The cash flow statement shows the inflow and outflow of cash during a particular period. Budgeting is an essential component of financial management in a business. A budget is a financial plan that estimates the expected revenue and expenses for a specific period. Budgeting helps to ensure that the organization has enough resources to achieve its goal and objective. A budget can also help to identify areas where the organization can reduce expenses and increase revenue. Forecasting is the process of predicting the future financial performance of a business. This process involves analyzing historical data, industrial trends, and economic factors to make an informed prediction of future revenue, expenses, and profit. Forecasting helps to identify potential risks and opportunities that may impact the financial performance of the organization. Financial analysis is the process of analyzing the financial statement of a business to evaluate its financial health. This process involves comparing the financial ratio and metrics of the organization with industry benchmarks and historical data. Financial analysis helps to identify areas where the organization is performing well and areas that require improvement. Investment decisions are the process of deciding how to allocate resources to maximize the return on investment. This process involves analyzing the potential risks and rewards of different investment opportunity and making an informing decision based on the organization goals and objective. Investment decision can be short term or long term, may include investment in few new products, equipment, or technology.